Welcome back to the Brent Bruce Daily for December the 27th, 2022. Almost the end of the year here. I hope you had a good holiday weekend and some time off over the Christmas holiday time. It is now 3:45 p.m. Central Time. We're going to take a look and see where home loan interest rates are right now, why they are where they are, and unfortunately, why it doesn't look like we're going to end where I wanted to end, which was in the high fives going into January on our Brent Bruce Daily 30-year fixed conventional because of something that came, I don't want to say out of nowhere, but something that we had not talked about that jumped up and really kind of bit us. So let's take a quick look here. First of all, let's take a look and see where we are on the charts today. We're down 19 basis points on our mortgage-backed security that we follow. We're unfortunately up 10 on the 10-year Treasury, which is, you can see this kind of creeping back up closer to that 4% number, which is not what we want to see. So let's take a look at the charts. You can see over the last few days, we've broken below 1, 2, 3 floors of support. When we were up here on this day here last week, we were talking about that we were fairly confident and comfortable because we did have 3 floors of support under us. Well, we have broken through those. Now, why did that happen when we had a good personal consumption expenditures reading come out? Last week, I've been talking about that we were preparing for the personal consumption expenditures report, which we felt was going to be in our favor, showing inflation subsiding. And it was. It came in at a 0.2 month over month reading on the core personal consumption expenditures reading, which is what we asked for, what we wanted. Unfortunately, it came along with a $1.7 trillion spending bill that had just passed the Senate. It quickly passed the House, and now I believe is currently on the desk of the president to be signed. Now, you have to understand, again, we've talked about this many times in the past. Inflation is the result of too many dollars chasing too few goods. Now, the inflation that we experienced in the first half of this year, 2022, was not only because of the results and the flow through of this massive injection of capital from the federal government during 2020 and 2021, but that then ended up causing a shortage in almost every product. So I like to always use my Snickers bar example. If all of a sudden everyone is flush with cash and they decide they want to go out and buy all the candy that they can get their hands on, the Snickers bars are going to disappear quickly, more quickly than normal, which means there's going to be a shortage of that candy bar. They're going to try to create more and try to produce more as quickly as possible, but all of a sudden now you're having nut shortages and chocolate shortages and nougat shortages, caramel shortages, whatever makes up that bar of candy. And that's what we experienced when you were talking about the ports all being backed up, plus people that weren't wanting to work. There was all these things going together that caused massive inflation. We were beginning to get that under control, but the government in the last couple of months released a $1.5 trillion Inflation Reduction Act, and then now a $1.7 trillion spending bill, which part of it is to basically keep the government moving forward. But this bill, guys, the spending bill that was it looks like it's going to be passed and was passed by the Senate and the House last week was 4,000 pages of spending. 4,000 pages. So this is the end of the current term for many people that lost their seats or are retiring from the midterm elections as well. Tremendous spending took place, which means $1.7 trillion is going to work its way into the economy. That is an enormous number. We're getting used to hearing the trillion word, but that was something that we didn't even hear about only a few years ago in as far as government spending. It was too much. Now this is becoming normal, which is pushing cash into the economy, which is tremendously inflationary. So even though, thinking about what we know, even though we have reports now of inflation subsiding because of the effects of the Federal Reserve increasing the federal funds rate, and also there being a normalization in the injections of capital into this country and people going back to work. So there was a time when people wouldn't work for a long time because they were getting money from other sources, or their expenses were being delayed, school loans and many other things. Well, now all of that has begun to normalize. But here we are now where the government comes in and just throws a big pot of gasoline on the inflation fire, which is not what we wanted. And we were, really expecting that the government was trying to get inflation under control because of the massively damaging effects to all people, especially those on the lower income spectrum. It hurts them the worst. People that make $300,000, $400,000, $500,000 can still fill their gas tank, and they go, "Oh man, it's 150. Wow, it used to be 100. Oh well," and they move on. People who don't have an extra $50 laying around, it becomes very difficult. Inflation affects those with the lowest incomes the most, or fixed incomes. Unfortunately, the government spending $1.7 trillion, this is not a political discussion or commentary. This is a fact. So now they've spent $1.7 trillion more, which is highly inflationary. And this is going to throw a wrench into the works as far as what we have been expecting. Now, I do believe that inflation is continuing to subside, but that $1.7 trillion will begin to show itself in the coming months, probably the later half of 2023. That is why we are not seeing home loan interest rates improving after a good personal consumption expenditures report. So I know we've already gone pretty long here, but needed to get some of that information out. So where are we on our home loan interest rate, since we're not at 5.999 or 5.875 like I had hoped for? We are currently back to 6.49%. This is exactly what I'm talking about. We get an excellent inflation reading on the personal consumption expenditures, but the market hearing the government is going to pump $1.7 trillion into the economy. The bond market does not like that because that is highly inflationary. We're back to a 6.5 now. Hopefully we will see things calm down a little bit before we go into the final days of the year. Well, we're in the final days now, but hopefully in the next couple of days, we have Wednesday, Thursday, Friday, and Friday even, is going to be either a short day or a closed bond market day. I'm not sure because of the holiday coming, but hopefully we will see it come down. Maybe we'll be at 6.25. Maybe we'll be at 6.125, somewhere in that range. And maybe we'll be in a position where maybe for a half of a point, we can get to that 5.99, because here we are now. If you want to get a 5.999, it's going to cost you almost 1.5 points. Remember, it was costing 0 points only a few days ago. So I'm sure that for those of you who watch this show regularly, you're starting to really understand. Here's the breakdown of the Brent Bruce Daily scenario that we just looked at, which is a highly qualified 30-year fixed conventional loan. I'm sure for those of you who watch this, you've learned a lot in the past year. And we're going to continue to teach on what's going on. Continue to let me know what you're looking for. But you're also now seeing the effects of moves that the government makes, that international governments make, that the stock market has, all on home loan interest rates. It's not just a number that gets spit out by a bank. This is something that is affected by the bond market and the movements in the general economy and the global economy. So hopefully you've learned a little bit this year. I'll give you a couple more tidbits here before the year ends, and then we'll start talking about a little bit more lengthy conversation on what we expect for 2023. Some of the things that we need to see happen in 2023, but that just changed because of the move that the government made, dropping $1.7 trillion into the economy over the coming months. That's what's going on. Let me know your thoughts. Let me know, like, subscribe, and share, and I will talk to you again tomorrow.